Ashish, Vinit, and Reema were partners sharing profits and losses in the ratio 2:1. Their balance sheet on 31st March 2024 is given to us, and we have been given a whole bunch of adjustments. They've told us to pass necessary journal entries on Vinit's retirement. Okay, so this is a question on the retirement of a partner, and we will go line by line. Okay, and before that, it's still good practice to mark the adjustments. Goodwill will be managed, no problem. Value of the stock is being reduced. Okay, so we just put a dot next to stock. Okay, patents are found undervalued by 20%, so we will deal with patents. Vineet was paid 20,000 immediately on retirement, and the balance was transferred to his loan account carrying interest at 8% per annum. Okay, and as long as you know the golden rules, life is easy. Frankly, I'd say journal is less effort than ledgers. And now we can go line by line. So capital accounts is nothing for us to do, but the general reserve needs to be broken up and given to the partners. All right. So general reserve calculation. Our general reserve is equal to 50,000, which needs to be broken up in the ratio of 2 is to 2 is to 1. Okay, so in the case of Ashish, it's going to be 2 by 5 into 50,000. In the case of Vineet, it's going to be 2 by 5 into 50,000. In the case of Reema, okay, 1 by 5 into 50,000. And 1 by 5 into 50,000 is going to give me 10,000, which means that these two are going to be 20,000 and 20,000. Okay, now remember in the balance sheet, all the liability items have a credit balance. Okay, they all have a credit balance. All the assets have a debit balance. Now, the general reserve has to be wiped out. Okay, we want to make the general reserve zero. The general reserve has a credit balance. If we want to reduce it, we have to subtract. Subtract means we have to debit. And accordingly, accordingly, we will credit. Okay, accordingly, we will credit the partners. So it's going to be general reserve account debit. Okay, in the books of Ashish, Vinit, and Reema. In the books of Ashish, Vinit, and Reema, the first journal entry we have. Okay, keep in mind all the dates over here are going to be the 31st of March 2024. So once and for all, we can write 2024 March, March 31st. Okay, 31, and that's it. Going forward, don't bother repeating it. If you want to, you can, not necessary. Now, uh, we have a general reserve. Okay, so the general reserve account gets debited to the partners. So to Ashish's capital account, to Vinit's capital account, Vinit's capital account, and to Reema's capital account. We give it to all the partners. Reema's capital account. Okay, and I'm going back to have a look at the numbers 20, 20, and 10. Okay, 20, 20, and 10. 20,000, 20,000, and 10,000. We know that the original general reserve is 50,000. Okay, so being general reserve, general reserve distributed to partners in the old ratio. Okay, do that and draws a line. Okay, straight line and scale. Now, once you're done doing that, okay, we move on to the next entry, and that is to do with patents. They're telling us that patents are found to be undervalued by 20%. That means this 80,000 corresponds to 80%. We want to increase it. 100% is going to be X, and we cross multiply. X is equal to 80,000 into 100% upon 80%. Do the math, you're going to end up with 1 lakh. That means the true value of your patents, the true value of your patents is 1 lakh. And right now it is valued at 80,000. Patents have a debit balance. If you want to increase it, you will have to debit further. We are going to have to debit 20,000 in order to add. Okay, and that means patents account will be debited. Who will be credit? The revaluation account. All right. The value of your asset has increased. So it is effectively debit what comes in. Okay, account, patent account debit to revaluation account, credit on incomes and gains to revaluation account, 20,000, 20,000. Being patents undervalued by 20%. Right. Next, we draw a straight line. Okay, please use a scale when you'll do it. A straight line. And then we move on to the next entry. Okay, and that is to do with stock. All right, so I am done with patents over here. Okay, stock they're saying is to be reduced by 10,000. I think that's straightforward. Stock is an asset, asset has a debit balance. If we want to reduce 10,000, that entry is going to be a credit entry. So we are going to credit the stock account, and therefore we will debit revaluation account because it's a loss for us. The value of our asset is reducing. Revaluation account debit, revaluation account debit to stock account. Okay, and both of them we have 10,000 and 10,000. All right, and it is being value of stock reduced. Being value of stock reduced. All right, now uh, we don't have any other transaction for eval. Okay, what is next is the partner being compensated. What we have over here is goodwill. So we are done with the two revaluation account journal entries. Now it is time to close the revaluation account. And remember, you don't need to make a reval account to close the reval account. Okay, I mean, the first one is general reserve we already dealt with. These are the only two entries. Revaluation account has been credited over here and it has been debited over here. Credit 20 and debit 10. So 20 minus 10. 20 minus 10 is going to give me 10. So 10,000, we have a credit balance in the revaluation account, right? 20,000 credit. Okay, and I'm just going to very roughly. Okay, if I've got 20,000 credit and I have a 10,000 debit, okay, then 20 minus 10 gives me 10. But which sign is higher? Credit. So the revaluation account currently has a credit balance. To make it zero, I have to debit. Okay, so revaluation account will be debited by 10,000. But I cannot give 10,000 rupees just like that. I have to break it up among the partners. I have to break it up among the partners in the old ratio. Okay, and we will clarify what that old ratio is, 2:2 to 1. Okay, so I'm guessing 4:4:2 should work. 4,000 and 2,000. Okay, 2 to the partner's capital account. But who are these partners? Ashish Vinit and Reema, to Ashish's capital account, to Ashish's capital capital account, to Vinit's capital account, and to Reema's capital account, being gain on revaluation transferred to partners capital account. Okay, if you want, you can say credited. Either way. Okay, transfer to partners capital account. With that, we are done dealing with revaluation. Our next step is going to be to deal with goodwill. Okay, the goodwill of the firm was valued at 60,000, and the same was to be adjusted in the capital accounts of Ashish and Reema, who will share profits in the ratio 3:2. So new ratio, okay, new ratio is 3:2. Old ratio, old ratio is 2:1. Who's leaving? This guy is leaving. Vinith is leaving. All right. So I want to calculate the gain ratio, because when one partner leaves, the remaining partners get more share. So gain ratio is equal to new ratio minus old ratio. So I have two partners left. Okay, and the two partners left is going to be Ashish and Reema. So in the case of Ashish's gain, it is going to be the new ratio, which is 3/5 minus 2/5. And similarly, Reema's gain is going to be 2/5 minus 1/5. And you'll notice how both of them end up becoming 1/5. And add them up, you will get 2/5, which is by the way, the retiring partner share. That's how you know you're right. Okay, so anyway, I have 1/5 is to 1/5, which I can say is 1:1. So the gain ratio is 1:1. And they're telling us the goodwill of the firm is 60,000. So first of all, we take this goodwill, okay, and we multiply it by the retiring partner's share. And then we divide. Okay, among partners, divide among partners in the gain ratio. So as far as the goodwill is concerned, it is 60,000. The retiring partner share we know is 2/5. Okay, and first solve this. 5 ones are 5/12s are, we're going to get 24,000 as the share of goodwill of the retiring partner, which is then broken up in the ratio 1:1. So 12,000 and 12,000. Why? Because it's in the ratio 1:1. All right. So, as far as our calculations are concerned, okay, there's no goodwill account, first of all. It's not there in the balance sheet anyway. And even if it was there, we would have written it off and then separately done this calculation. Secondly, there's no goodwill being brought in where we can have a premium for goodwill account. This is just going to be a direct entry between the three partners. Okay, so Vinit will be credited because he's giving his share to the remaining partners. And Ashish and Reema, Ashish and Reema are gainers. Okay, so they are the receivers. We debit the receivers in this case, receivers, and credit the giver. And the giver is Vinit. Right? And accordingly, we pass our entry. So it's going to be Ashish, Reema, Vinit. Ashish's capital account debit. All right. Reema's capital account debit to Vinit's capital account. And we have 12,000, 12,000, 24,000 being Vinit being Vinit's share of goodwill credited by remaining partners, if you want, from remaining partners in the sacrifice ratio. If you want, you can mention it. That is to 1. Okay, and please make sure your handwriting is good, consistently good. Okay, can keep the examiner happy. Now, we have a little bit left. Okay, anything? We are done with the goodwill calculation. Vineet was paid 20,000 immediately on retirement, and the balance was transferred to a loan account carrying interest at 8% per annum. And so the question is, what is that balance? Okay, I will first make the entry. Okay, I will first go ahead and make the entry where um, Vineet is getting money and we have to empty out her capital account. All right, so I'm going to scroll down. Okay, and let's see if we can squeeze it in. Vineet's capital account is going to be debited by her full balance. What that is, I do not know. We have to calculate. She is going to be given cash. Okay, now whether it is cash or bank, look over here and see. It is cash. So we will say cash. Okay, so to cash account. Okay, to cash account. And the entire amount of cash is going to be 20. Okay, 20,000. That I'm going to write down now only. 20,000. And the balance amount is going to be to Vineet's loan account. All right, now I need to find out the balance of Vineet's capital account. And for that, I have to go through the balance sheet and take this 2 lakhs. This 2 lakhs is a credit balance. Remember, liabilities have a credit balance. And then wherever you see credit, okay, wherever you see credit, this is credit, this is debit. Okay, wherever you see credit to Vineet's account, you will add. So that is a plus. I'm going further down. Where else do I see Vineet account? Over here? Plus. Anywhere else I see Vineet's account? Over here? Plus. Okay, interestingly, there's no minus. Great, no problem. What is that? So we are starting with which number? We are starting with the number in the balance sheet, which is 2 lakhs. 2 lakhs plus 20,000 is 2 lakh 20,000 plus 4,000 is 2 lakh 24,000 plus 24,000 is 2 lakh 48,000, and that is going to be the balance in her account, 2 lakh 48,000. Minus 20,000 is going to be her loan.